Calendar year 2022 is on track to deliver low single-digit returns like the previous year. But this is where the similarity ends. 2022 saw sharp rise in global inflation, which was supposed to be transitory. This forced global central banks to raise policy rates sharply and tighten financial conditions. This caused sharp reversal in capital flows, increase in bond yields, and fall in global stocks and bonds. Back home, the Reserve Bank of India raised the repo rate from 4% to 6.25% in 2022 to tackle sticky inflation and drain liquidity of almost 7 trillion rupees. This caused sovereign bond yields to experience bearish flattening. Going into 2023, we expect the Reserve Bank of India to raise repo rate probably one more time to 6.5% if required, and then be on a long pause. That said, RBI will continue to sound hawkish. This should keep sovereign yields elevated for some time before easing. We also expect private sector to play a greater role in 2023. Indian macros are a mixed bag. While headline inflation is below 6% for the first time since January 2022, core inflation is still sticky and broadening. This poses a challenge for the Reserve Bank of India in 2023. Second, India's current account deficit for FY23 is trending towards 3% of GDP. This is concerning. Higher current account deficits indicate economic overheating and adds pressure to the rupee-dollar exchange rate. That said, India's growth remains robust and tax collections are rising. Normal monsoon will help raise farm output and support rural consumption. On US markets, we believe that the Federal Reserve will remain hawkish and raise policy rates further till inflation starts slowing. This will keep US bond yield curve inverted in our view. RBI's December policy was understandably hawkish. While the headline inflation was going to trend lower going forward, the RBI is uncomfortable with sticky core inflation at 6% plus. RBI has also noted that India's economy is cooling off. Despite that, they chose to remain hawkish on inflation as they are concerned about broadening of the core inflation and its impact on consumption. Based on this, we believe that the RBI will continue to sound hawkish next year until core inflation will start easing. This should keep sovereign yield curve flatter in our view. We expect government bond yields to trade in a narrow range in the near term. An important trigger for the government bond market investors will come in the form of Union Budget for FY24. Bond market expects the fiscal deficit to be cut by at least 50 basis points to 5.9% of the GDP. Bond market will also focus on the size of the government borrowing in the next year. Bond market will also focus on the RBI's view on the demand-supply dynamic for the bonds in the next year, as well as the measures taken by the major central banks. All this should keep benchmark sovereign yields from trading in the upper band of the trading range in our view. Corporate bonds have been sharp improvement in their primary supply lately. If this trend remains, then it should cause gradual widening of credit spreads in our view. Flatter yield curves will provide little incentive for investors to add duration in their portfolio in the next year. That said, given the juicy level of yields, we expect investors to earn higher income next year with potential for slight price appreciation. We suggest investors to consider investing in target maturity funds, investing in GSEC and SDL with 5 years plus maturity bucket for superior tax-adjusted returns and long-term fixed income allocation. Happy investing.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.